Welcome everyone. I can see that we have a number of participants joining from around the world. So we will aim to start on time, and I'm hoping that the other participants who subscribe to this webinar will join us soon. So welcome to everyone. First, Happy New Year. We're wishing you all, I think, safety and prosperity, and I think above all, a lot of health. And a healthy 2021 and the years beyond. I would like to welcome you to APICORP's MENA Power Investment Outlook webinar. We are covering, as usual, the next 5 years. And this Power Investment Outlook concludes a series of our investment outlooks. As you know, we have now a tradition of issuing our energy investments outlook early in the year. And then we follow it with a series of sectoral investments outlook, and the one that we just released just before Christmas was focused on electricity. And if you remember, for those of you who were joining us for the previous webinars, we had already at the time mentioned, of course, the roughly 20% decline in energy investments in the region. But more importantly, we think that the recovery will take much longer than previous downturns. We also presented the concept of a global reset in the energy sector that is very much relevant in the power sector as well, probably more relevant in oil and gas, where we'll see a lot of consolidations and mergers and acquisitions, but we can see the same potentially happening in the electricity sector. And before giving the introduction, I am joined here by my colleagues, my dear colleagues who worked hard to issue this Power Investments Outlook. Our senior energy specialist, Suhail Shatila, who's joined us a few months ago and who is very much an expert in power. And my colleague, also senior energy specialist, Ramy Al-Ashmawy, who some of you already know because he's been leading the gas investment outlook a few months ago at the beginning of the fall. But before giving the floor to Suhail and Ramy to drive you through the insights of the Power Investments Outlook that you can find definitely on our website, I just wanted to give you some fresh thoughts or what we see when it comes to recovery and where we see the macroeconomics and the future of the energy sector as it stands in January 2021. Of course, it's been a rough year for everyone, and it's been a rough year for the energy sector as well, and for specific parts of the energy sector that were supposed to handle the pandemics, especially when it comes to residential demand, as students have to pursue their studies at home, and people had to work from home. And Suhail will give us some insights on how electricity demand has been changing during the year of 2020 and how he sees that affecting the future of electricity demand in the next few years. But the point that I wanted to say is that the next decade that we are seeing, the upcoming decade, will likely be marked by, I think, three major global challenges. And I think you would agree with me that the first major challenge will be to build a resilient and sustainable post-pandemic recovery, number one. Number two, we will need to achieve the universal access to energy for all. And number three, we need to tackle climate change urgently. And guess what? The electricity sector is definitely a major part of those three major challenges. And there's a huge interdependency between the recovery in the electricity sector and the economic recovery of the world and of the region. In January 2021, we see actually divergent paths for recovery, and these divergent paths for economic recovery and in the energy sector will be shaped by policies. And the reason why I'm insisting on that is because today we will be talking about the electricity sector, and that's definitely a sector, particularly in this region, that is very, very much dependent on regulations and government policies. The other point that I wanted to mention is that the recovery will be mixed. and it will not be necessarily sustainable across the board. We will see some countries, some companies, some corporations, and some sectors within the electricity sector as well that we will do better than others. And I think we have still subdued domestic demand, subdued inflation, a weak dollar, and debt and stimulus packages that are piling up that will make that recovery. You will have a rebound basically in 2021 for sure, but we're not sure whether you will have a sustainable recovery beyond 2021. So it's slide 1. We are giving you a broad overview of the overall reduction in electricity demand that we are seeing around the world, and that is also relevant in the MENA region. The IEA has mentioned that global electricity demand has dropped by 5% in 2020 compared to 2019. And you have examples that the EU was hardly hit with a -8% in 2020 of electricity demand drop. I think what is important in this slide is the comparison between renewables and how it fared compared to other primary energy demand sources like oil and gas, where you see a drop of between 5 to 9% in 2020. There are a lot of, I think, interesting questions that are being asked regarding the recovery of electricity demand, because if we are all targeting a more electrified economy, a more electrified society, and a more digitalized society as well, and economy, the electricity sector will continue to play a major role when it comes to electricity demand, but we will have to look at how the fuel mix will evolve, because for the time being, even if many countries in this region had ambitious targets, very few of them have the ingredients, I think, to have a sustainable and increasing their renewable capacity to be able to cover the demand on a resilient basis. So I'll give now the floor to Suhail, who will drive us through first how he saw electricity demand in the region behaving over the last year. Thank you, Suhail.
Thank you, Dr. Leila, and welcome everyone. Thank you for joining us today. Well, as Dr. Leila said, the year of 2020 was unprecedented, and while doing our analysis on the power demand and the impacts on the power demand, we saw that the impact usually on the pandemic it results on the power market structure and the power consumption mix. So when looking at the power consuming sectors of any economy, basically the residential, industrial, and the commercial sectors, we noticed while doing our analysis at APICORP is that there was a trend of increase in the residential power demand at the expense of the commercial and the industrial power demand. Now, what is interesting is that in the MENA region, on average, 41% of total power demand is consumed by the residential sector. And this, in effect, countered to a certain degree the overall power demand drop in the region. So while, as Dr. Leila said, the global average drop as estimated by the IEA was 5% in 2020 compared to 2019, in the MENA region, it was estimated at around 2% due to the fact that the residential power sector is a large portion of the power consuming in the economy. Now, while looking at the supply side of the equation, in any centralized power system, power dispatching is usually a function of several variables, among which are the power plant's cost curves and the power availability. Now, as the pandemic took its toll in the year of 2020, the need for the must-run technologies such as nuclear and renewables led to the increase in the contribution of these technologies in the power generation mix. The IEA also estimates that the share of renewables from the global power generation was set at 30% in 2020, up 3% from 2019. The same trend is also noticed in the MENA region, where in 2021, 3 gigawatts of renewables are to be added. And for the upcoming 5 years, around 20 gigawatts are to be added, mainly driven by solar PV and wind additions. Okay, while also looking at the supply side of the equation, now the intermittency issue of the renewables and the lack of having a commercially feasible energy storage solution to date, this means that fossil fuels, coal, and nuclear will remain indispensable components of the power generation mix for the foreseeable future. Now, the rate of penetration of renewables in the power generation mix will be dependent on policies, regulations, and subsidies. In the MENA region, this is dependent on two main factors. First of all, the cost curves of renewables, as well as the ambitious national policies and targets ranging between 13 and 52% of installed capacities by 2030 as being generated from renewables. Now, of course, natural gas remains a major pillar for power generation in several MENA countries, such where it represents around 90% of power generation in Egypt, UAE, and Algeria, and 2/3 of the power generation mix in Saudi Arabia. Now, of course, in 2020, due to the impact of the pandemic, the share of natural gas in the power generation mix fell in favor of renewables, mainly solar PV, wind, and hydropower. Now, that trend was noticed in Egypt, UAE, and Jordan. As for Morocco, the share of coal and oil dropped in favor of solar PV, wind, and hydropower. Now I will give the floor to Ramy to discuss the impact on power projects.
Thank you, Suhail. If you recall our investment outlook and the gas outlook, we always like to analyze the year-on-year change in investments and projects by sector from each given year's outlook vis-a-vis the previous year's outlook. This shows us how 5-year investment horizons are moving for each sector. And we could see here that the power sector actually, contrary to the power market, the power sector investments suffer a huge decrease, 2020 to 2024 versus 2019 to 2023. The majority of this decline is actually in planned investments, and this shows the effect of the 2020 combined crisis on the plans and perceptions of the MENA countries. While committed investments were almost unchanged when we did our investment outlook back in Q2, a slight revision was prompted in Q4 while we were developing the power outlook, because Egypt had canceled the coal-fired power plant, Hamraouen, for almost $4 billion. And Kuwait also canceled Al-Dabdaba project, which gave us a decline of $4 billion, more or less. So, the year-on-year change in power is almost 33% decline versus last year's outlook. Now the split between committed and planned investments. As you know, committed investments are all the projects that are in execution phase. So anything that is currently in execution is committed investments, while planned investments are everything else, basically. The committed investments can be a measure of the rate of execution of projects and plans of a given country or region, in the sense that planned investments target to long-term objectives, ambitions, while actually committed investments are the investments that are that go through the post-FID stage to actual delivery and completion. The UAE, Egypt, Iran, and Iraq and Saudi Arabia are the top 5 countries for committed projects value for our investment horizon 2020 to 2024. While Saudi Arabia, Egypt, UAE, Algeria, and Kuwait have the highest portion of planned projects. Of course, all the quotations are by value in USD billion. For the committed projects, we see that there is a high risk of delays and even possibly cancellations for Iran and Iraq, due to the current economic pressures faced by the two countries. For the planned projects, however, we see that there might be some postponements and also cancellations from Algeria and Kuwait. We wouldn't see these as cancellations per se, but more optimizations though. Please go ahead. And now we're talking about the generation, the split between investments in generation and transmission and distribution. So the MENA region has fared below the international average of 20% for transmission and distribution versus the total investments in power sector. Our estimate for 2020 to 24 is currently at 12%. Of course, this is the average or the aggregate of the MENA countries that we study. But countries vary in this proportion from generation to T&D based on the different priorities facing each country. In some countries, there was a generation problem, a capacity problem. In other countries, the needs are more towards modernizing the network and investing in connectivity and remote locations. We expect this percentage to go higher as renewable targets and the very ambitious renewable targets that almost all MENA countries share will require distributed grids to be connected, the implementation of smart metering and smart grids, in addition to storage solutions as well. The other aspect that is expected to drive transmission and distribution investments is the interconnectivity, regional interconnectivity. As different countries have loudly voiced their plans to connect their grids cross-border and engage in electricity trade, this will require investment in transmission and distribution with substantial quantities and substantial magnitude. We have the Egypt-Saudi interconnection, we have the GCC interconnection with Iraq, we have the Iraq-Jordan-Egypt proposed connection, interconnection that was signed in summer of 2020. We have an interconnection proposed, an expansion of the interconnection between Egypt and Sudan, another proposed expansion between Egypt and Libya, and most recently the Egypt-Euro interconnector for 2 gigawatts through Cyprus. The distribution sector in specific has been slowly opening up for private sector participation. Morocco was a pioneer, has been a pioneer in this, followed by Lebanon. In 2019, we saw Oman and the UAE, and recently Saudi Arabia and Egypt. So we expect the distribution sector to continue opening up for private investments. Now we'll focus on the generation mix, the generation projects. Generation projects, which account for 88% of breakdown by value, both committed and planned, have the highest concentration in solar power projects, which again reiterates the trend that Dr. Leila and Suhail were speaking about, the very ambitious renewables targets that MENA countries have committed themselves to. So almost a third of the planned and committed generation projects in the MENA region are actually solar projects. Oil and gas conventional power plants still contribute slightly more than a quarter. And this is basically driven by natural gas, and shifting to natural gas as a cleaner fuel. We could see this developing in Saudi Arabia, in the UAE, in Egypt, in Algeria as well, where domestic consumption of natural gas has skyrocketed in the last 2-3 years. Nuclear plants also start to take a considerable share in the generation mix for the upcoming investment horizon 2020 to 24. We have Al-Dab'a nuclear power plant in Egypt. We have the continuation of Al-Baraka in the UAE, and the inauguration or the start of the modular reactors in Saudi Arabia. Coal remains sticky in the generation mix due to some few projects that countries continue to hold to for different reasons: energy security, cost reasons, maintenance of balanced mix. So we have the Hassian, for example, in the UAE, the Hassian project. We have Ras Al Khaimah also in the UAE. They have 1.8 gigawatt coal-fired project. We have a couple of projects in Oman. We have also a rehabilitation of a coal-fired power station in Iraq. Iran also has committed projects for coal in the upcoming investment horizon. I will now hand back to Suhail to continue with the presentation. Thank you very much.
Yes, thank you, Ramy. So the role of the private sector and financing is still largely dependent on the sector reforms and the government payment guarantees. Most power markets in the MENA region are still following the single buyer model, anchoring long-term PPAs, where the highly leveraged power projects are being financed based on a non-recourse or a limited recourse financing structure with a debt to equity ratio ranging between 60-40 and 80-20. As for the low risk projects, which are backed by strong and long-term government payment guarantees, these are being financed based on an 85-15 debt to equity ratio. Two major developments that happened in 2020 that I would like to highlight is, first of all, in Egypt, with the restart of operations with the 4.8 gigawatt Al-Dab'a nuclear power plant, where it was announced that the groundworks and the site preparations has commenced as of October 2020. Now, regarding the financing structure of the project, $24.5 billion will be secured by Russian banks through long-term loans to the Egyptian government, whereas the remaining $5 billion has to be secured by the Egyptian government itself. The other main development that I would like to highlight in Saudi Arabia, where the financial restructuring of the national utility company, the SEC, in order to enhance its business model and to promote its financial sustainability. The restructuring happened at three different levels. First of all, the reclassification of its outstanding liabilities amounting to $44.8 billion, which represent a third of SEC's total assets, and transforming these liabilities into a subordinated, perpetual, non-dilutive equity-like financial instrument with a rate of return of 4.5% per annum. The second measure that was taken is the cancellation of the government fees amounting to $3.7 to $4 billion per annum. The third and the most important measure that was taken is the adoption of the RAB model, the regulated asset base model, in order to manage and regulate SEC's revenues and to make sure that SEC is able to meet its operating expenditures on one hand, as well as to pay out dividends to its shareholders on the other hand. The return of capital on the RAB model was set by the regulator at 6% for the upcoming 3 years, effective January 1, 2021 till the end of 2023. Of course, the RAB model is an important tool for setting the tariff that will be implemented for the consumers. Now I will give the floor to Dr. Leila to discuss the competitive advantages of the MENA region when it comes to low carbon and net zero products.
Yes, thank you very much, Suhail. And I think this is an excellent transition from what is happening with the Saudi electricity company financial restructuring and wider reform of the electricity sector in Saudi Arabia to the story that one of the stories that we wanted to highlight in this outlook, which is that the MENA region has clear competitive advantages to play a major role as an exporter of hydrogen, but also other low carbon or zero carbon products like ammonia that would be important for the wider energy transition. And the reason why I'm insisting on the regulatory framework and the financial restructuring of a national utility in the region is because if you take, there are not many, some few countries in the region have that coincidence of low-cost gas and low-cost renewables. What is missing is the regulatory framework that will enable them to basically oversize and capture the potential of that low-cost gas and or low-cost renewables. So we are today in a situation where the world is ongoing this energy transition, as I mentioned earlier, to tackle the third major challenge of climate change. And there is a clear possibility for, if I take the example of hydrogen, to play a major role. We've already seen the first shipment of blue ammonia recently by Saudi Aramco, but the point that I want to make is, if you take the cost today, if I take the example of hydrogen through steam reforming and hydrogen being produced through electrolysis, there is a factor of 3 to 4 times. The cost of production of hydrogen through steam reforming is 3 to 4 times lower than its cost, production cost through electrolysis. For now, today is 3 to 4 times. This cost might decrease, that gap might decrease in the future if we see indeed additional decrease in renewable costs. However, if you add also CCUS, and mind you, APICORP has been one of the signatory banks of the CCUS financing principles. If you add CCUS to your gas generation to produce either hydrogen or blue ammonia for that matter, I think the economic costs of production will start to be very close to each other, and we might see actually a race within the region between those who have access to low-cost gas and or low-cost renewables. 2 examples that we featured in the report are Saudi Arabia and Morocco. There you go, 2 countries who have, in theory, the economic features of emerging as major producers of low carbon or net zero carbon products, hydrogen or ammonia. The one thing that is missing is the regulatory framework and ability to access and to oversize and to unlock that potential through reforms, through the tariffs that Suhail has been talking about in the specific case of Saudi Arabia, and more generally a need to unlock the potential of the region, given this race that the several of these countries will be embarking on. So I think this was one of the key highlights of this Power Investments Outlook. Is a lot will depend, and I see that in the questions in the Q&As already. A lot will depend, I'm afraid, on the policies that are being pursued by these countries, because the potential is definitely there. And now I will turn to Suhail again for the last few slides before moving to the Q&As. Thank you.
Yes, thank you, Dr. Leila. So in order to make economic sense behind regional interconnectivity between the MENA countries, we did a levelized cost of electricity modeling between 2 different technologies and 2 different MENA countries. We chose Saudi Arabia and Egypt for this exercise, and the reason we did that is because of the peak load timing difference between both countries. So the peak load timing in Saudi Arabia occurs by the end of August, early September at around 2:30 p.m. Whereas in Egypt, the peak load time occurs end of July, early August at around 8 p.m. in the evening. So clearly, due to this peak load timing difference between both countries, this makes a viable commercial proposition for electricity trading between them. Now, when we did the exercise, we decided to compare 2 different technologies. So we decided on a 300 megawatt solar PV power plant on the western coast of Saudi Arabia and a 1059 megawatt combined cycle gas turbine CCGT on the eastern coast of Egypt. When calculating the LCOEs for the CCGTs, we did that based on 2 pricing scenarios, a low price of $2.75 on the MMBTU and a higher price at $4 on the MMBTU based on existing gas sales agreements in Egypt. The resultant LCOEs were for the CCGTs were between 4.5 and 3.7 cents on the kilowatt hour, and 50 to 60% of the overall cost is represented by the fuel cost. As for the solar PV power plant in Saudi Arabia, the LCOE was calculated at 2.5 cents on the kilowatt hour, where 84% of the total cost is represented by the capex. Now, of course, the LCOE modeling has its own limitations, and it needs to be fleshed out with additional costs, especially transmission, distribution, and storage costs, for it to be much more comprehensive. But from this exercise, MENA countries having differences in peak load timing and with different power generating technologies, there is an economic sense in electricity trading other than trading just for emergency cases or security of supply. But based on economic principles, there is economic sense for electricity trading between the MENA countries. Now, in 2020, the MENA power market came out relatively unscathed relative to other energy sectors, and we believe at APICORP that the power sector is and will continue to drive the economic recovery in the region. Secondly, the other key takeaway is that, of course, due to the pandemic in 2020 and the repercussions of the pandemic that took place, the criticality of continuous power supply and digitalization of the sector were emphasized. Therefore, policy efficiency and digitalization will be key factors for shaping future power sectors and investments. Thirdly, of course, with further electrification of economies and the movement towards the low carbon and net zero products, MENA has a very strong potential for interconnectivity, as well as emerging as an export hub for the low carbon and net zero products such as hydrogen and ammonia. Now I will give the floor back to Dr. Leila for any questions and answers.
Thank you very much, Suhail. And I've been looking at the Q&As. I was surprised that nobody raised the fact that we are facing an extremely cold winter in the world, and there are fears actually of blackouts in Japan, etc. But I can understand that it's not credible when we are sitting in the Middle East with this in this sunny day. And while looking at the questions, I think we can start with the first question, which is about what's the renewable contribution to the total new projects. And I think Ramy has presented a pie chart, which you can show again, maybe Suhail, where you can see the distribution of the power mix over new projects, to show us that power chart, the one with the
50%, more or less.
So we can consider that question as done. I will leave the waste to energy question for now, but I would want to. I think the issue around hydrogen, we try to detail it in the report and also in the slides. We can give you some actual cost numbers. I mean, roughly through steam reforming, you can count of something between $2 to $3 per kilogram of hydrogen produced versus without CCUS. I'm sorry, and the cost for electrolysis of around more than $6 per kilogram. So for now, as long as you don't have that level playing field between the different technologies, and as long as you don't have a carbon price to have that level playing field, you will still have that gap between the two. But I think when it comes to hydrogen projects per se, as Ramy mentioned, we are looking into what has been committed and what has been planned by governments. We are pushing, we are definitely highlighting this as definitely an opportunity for the region, and it's up to basically the stakeholders to put that in their plannings. Suhail, do you want to answer the question about the RAB and the weighted average cost of capital mechanism that you see in Jordan? And well, basically the question is how frequent we will see RAB adjustments on changes on a yearly basis. I think that has already been decided, and how tariffs will be linked to minimum returns to investors. And the person is assuming that the minimum returns to investors will decline in the GCC region.
Yes, thank you for the very interesting question, Mohammed. Well, actually, the reasoning behind the adoption of the RAB model for the SEC was due to the financial restructuring due to the outstanding liabilities and because of the inability of SEC to meet its operating expenditures and to pay out dividends. So in order, whenever a RAB model is implemented, it is usually to manage the revenues by being backed to the assets, whether they are valued at historical costs or not, and basically valuing them based on a certain rate of return on capital. In the case of SEC, it was set by the regulator at 6%. Now, of course, the RAB model is also used by the regulator to set the tariff that is to be implemented on the consumers in a manner for it to be able to recover the costs and ensure that the national utility company is profitable to a certain degree, which is set by the regulator, as set by the regulator. I'm not sure the question was about Jordan.
Yeah, I think we can leave it there for now. I mean, the fact that utilities in the MENA region are in need of financial restructuring is not something new. So we are in that situation, and we don't want to start listing the number of national utilities that are definitely in a difficult shape, and what are the different mechanisms to ensure that they are able to fulfill their commitment over the next few years, especially those that are having, and I'm moving to the question about transmission and distribution investments, especially those national utilities that have to carry the burden of future transmission and distribution investments, especially transmission in the networks. And I would like to turn to Ramy now to tell us a bit more about actually a flag that we are raising in the report. And I think one of the questions in the Q&A list is highlighting the fact how much is the contribution of investments in storage systems. And as we all know, storage is also meant to maintain the stability of the system, particularly if you are having ambitious renewables targets. And how is that supporting the planned projects in transmission and distribution that we've seen actually that are quite relatively low, 12%, compared to the rest, to the planned investment in the energy, in the electricity sector. Ramy, would you want to tackle that?
Yes, I was disconnected briefly. Can you hear me?
Yes, we can hear you.
Yes.
So the issue of storage has risen to paramount level as in the recent years, MENA countries have focused on generation per se, installing solar and wind power generation capacity. The issue of intermittency has not been addressed in some countries, which resulted in serious problems for grid integration and also for the off-takers of power from these the new renewable power plants. This prompted the national regulators to reconsider the issue of integrating storage in the tenders of generation, because this has not been the case, for example, in Egypt. There were lots of cases with Benban, the flagship project in Egypt, causing problems with a lot of the off-takers, especially in the southern part, where there is usual intermittency between day and night, and also about sunshine. If you take the magnitude of the power generated from a plant like Benban, this actually caused blowouts in transformers down the line. So this has been a very good lesson learned for the Egyptian electricity company when factoring in or when proposing tenders for solar power and renewables, generally renewable generation. Investments in storage, it's still a question mark. Who will foot the investment in storage and battery clusters? Is there a viable commercial arrangement for an investor, like a non-government investor, to contribute to this or to invest in this? Is it bankable? It's still a question mark, but so far the government or the electricity company, the utility companies, will be footing the bill for such investments. We will see how Saudi Arabia tackles this issue with the NEOM, the flagship NEOM project. They have stated that there will be a mega battery cluster for NEOM. The project has been recently awarded. They will install a mega battery cluster, and is yet to be seen and yet to be disclosed how this has been or has transpired as a commercial arrangement, and how it's structured through the tariff of the electricity. So the region is slowly learning and using the lessons learned from the good success that has occurred in the last 2-3 years. The rate of completion and success in power and renewables has been so far very good.
Thanks, Ramy. And since you have the floor, would you like, there are 3 or 4 questions about waste to energy. Why we see such a small number? Do we see that as commercially viable in the region? It's supposed to be free, which is not necessarily true, because it comes from a, I would say, regulator policymaker perspective. It comes at a cost that somebody has to pay compared to just incineration. And basically how we see the viability or the sustainability of waste to energy schemes, especially without government support, without the state support.
Thank you, Leila. First of all, the pie chart does not show the number. It shows the value breakdown by type. So this is actually the dollar value of the projects, not the number of projects. So when we say 32% solar, it's not 32% of the number of projects, it's the value. So in that sense, I think the question is somehow skewed towards, or the question's mindset is skewed towards the number versus the value. Now, speaking about waste, as Dr. Leila mentioned, there's nothing free. Well, people thought that solar energy is free. And now everybody could realize how costly it is to develop solar and wind power. The issue of waste, yes, countries, human societies generate waste, but the full cycle of collecting, separating, and allocating and reallocating the waste, building the plants necessary to process the waste in a safe and environmental friendly manner, bears a cost. What is the ecosystem that regulates all the stakeholders of the waste processing industry? If we want to call it an industry, it's still a budding industry, but in developed economies, it is an industry. These are all still questions. Countries like the UAE have pioneered the waste processing, converting it to energy and recycling and recycled products, but it's still on a very small scale. In Egypt in 2020, there has been a breakthrough. The parliament ratified the first waste to energy law, regulating the waste to energy fee, pre-qualified players in all the value chain of the waste to energy. But it's yet to be tested in regards of bankability. I see one question referring to the bankability and the commercial attractiveness of waste to energy. This is still yet to be tested. So the government has passed the first stage by developing a framework that transpired into a regulation that was ratified by the parliament, but it's still yet to be tested, the attractiveness of this scheme. So in 2021, we are yet to see how attractive this is going to be, especially for a big country like Egypt with 100 million plus population. Imagine the waste that is generated on a daily basis. This is also a very good teaser for our 2021 investment outlook. We might actually be able to give some light on waste to energy schemes in the region and how the industry or this subsector is developing. Thank you.
Thank you, Ramy. I see a question that I will tackle myself on the foreign funds and whether they're continuing to seek exposure to MENA power schemes, and overall whether foreign investors are still attracted to the energy sector projects in MENA. And Suhail can complement because he presented the slides on the financing, on how to finance the power sector more specifically in the region compared to oil and gas, where it's mostly being financed through equity. I think from that perspective, this is related to a story that we have been highlighting very carefully in the series of our investments outlooks over 2020, is the fact that the energy sector as a whole is coming to this crisis after actually it's the third crisis in 1 decade that the energy sector is facing as a whole. And also it's coming to this crisis with having been the lowest provider of returns to investors, and by far, by a wide margin. If you can look at the S&P 500 returns to investors, the energy sector really is, I think, maybe 100 times lower than real estate or IT or other sectors. So from that perspective, the wider energy sector is providing a relatively low value proposition to your, I would say, impatient capital or impatient investor. Now, if the question is more specific about infrastructure funds, these are funds that are used to, let's say, single-digit returns that you will get now today in some parts of the energy sector, let's say pipelines, infrastructure, energy infrastructure, and transmission and distribution in the electricity sector, or even some power generation schemes. So from that perspective, I think the appetite for that in that specific niche will still be there because as you saw in this presentation, the MENA region is still a growing region when it comes to energy demand and electricity sector demand in general. Renewables are expected to play a major role. Now, as I mentioned earlier, it very much depends on what country you're looking at, because it is, as I mentioned earlier in the introduction, very much dependent on policy, very much dependent on whether the country is able to look at the financial sustainability and viability of the main off-taker, which is at the end of the day, your national utility. So I think these are all related at the end of the day to what sort of policy the governments are pursuing in that sector. But to answer that question in a short way, yes, I think patient capital from outside of the region, including infrastructure funds, will still be interested in financing various schemes, especially that we are seeing in now, as we have highlighted in this presentation, the need for different financing schemes, including to make sure that the renewable targets are being met. And you will see more and more pressure from the governments to the stakeholders, on the stakeholders, to ensure that the renewables targets are being met at nearly at any cost. So I think that would answer the question about foreign investments in the energy sector in the region. Suhail, would you like to add anything on that?
Yes, Leila, if I may add, actually, the year of 2020 and the pandemic, I think, emphasized this trend, the need for foreign investments, especially that we saw several oil-dependent economies that, due to the low oil prices and the disruption in the supply chains, they had huge deficits in their budgets. And therefore, the need for foreign investments is now more important than ever, now and going to the medium term at least. In the power sector, most MENA countries, they follow the single buyer model, and they anchor long-term PPAs. Usually, generation side of the power sector is done through the IPP modality, independent power producers, and usually they are backed by strong government payment guarantees. So for trust in any project when it comes to generation or distribution, because usually transmission is sovereign part of the power value chain. So I think foreign investments, given that local governments and domestic governments are faring quite not very well due to the pandemic this year, the need for foreign investments is now more important than ever, in my opinion.
Thank you, Suhail. Thank you. There is one question that is directed directly to me that I will tackle. Although, to be very honest, Mohammed, it has nothing to do with the electricity sector. But I'm happy to tackle it because you mentioned, I think, rightly, that transportation in general, because let's not forget about the automotive industry is not the only consumer of oil. You also have shipping and aviation. And these are the last portions, the last sectors that are taking us, are standing between us and the 100% recovery in oil demand in 2021. We now to get back to travel. We need to get back to driving and flying for oil demand to come back to its pre-pandemic level. But I think, saying that aside, there is a drive to the electrification of the transportation sector, like the electrification of the rest of the economy, that's for sure. But there's a limit to that, as we all know. I mean, you cannot really electrify shipping, and you cannot really electrify aviation. But for automotive, I agree that there is a tendency for oil demand in the transportation sector to reach a plateau. I don't like to use the word peak demand. I'm using the word plateau for a purpose, because you will still need, I think, a lot of behavioral change, charging stations infrastructure. Again, we get back to the regulatory issues, low-cost electricity available and sustainable for electric vehicles to totally replace your internal combustion engine. But take that aside, and I think your question is more about what the MENA region is doing, and basically the policymakers in the MENA region are doing to tackle that. They're doing many things in the meantime. And I think over the last few years, there has been a drive to put a lot of R&D, research and development money into, well, first making sure that the internal combustion engine remains important for transportation, important and basically low cost. Making sure, and that's, I think, an interesting move that you have, for example, if you look at the IMO regulations, you see specific sectors in the transportation providing their own answers, their self-inflicted answers to climate change, again, in the absence of global regulations or carbon pricing. And I think the last thing that they're doing as well is to pursue other consuming demand centers for their oil and gas. And I'm thinking about petrochemicals. And if you've seen some of the studies that are looking at long-term oil demand, you definitely see in all those forecasts, more or less, so that they can disagree on the actual number, but more or less you have 2 to 4, maybe 5 million barrels a day of additional oil demand between now and 2040, that is primarily going into the petrochemical sector and plastics. So as long as we don't find also, I would say, a drastic solution to plastics recycling, and that will lead to a total change of the plastic supply chain and consuming, the petrochemical sector is being viewed as a potential savior and additional, where you can gain some additional market share for oil and gas. That explains to you basically, that explains to you why you will see a lot of those drive for integration and that race to integrate refining and petrochemicals plants in the region and outside of the region. So I hope that will clarify some of the steps that the MENA region is taking to tackle this issue of plateau demand for oil. The gas sector, I think I would not want to get too much into that. I personally think that the gas sector will continue to grow, and the cargoes that we are seeing trading today with that cold winter in Europe and Northeast Asia are testament to that. You have some LNG cargoes that are trading at the equivalent of $150, $200 a barrel. So I think you will still need, because of the the fact that natural gas is quite versatile, you still need a lot of gas to electrify the economy and to tackle heat and air conditioning issues. But I think if your question is more about transportation, I think that issue has been watched very carefully over the last 15 years by the major oil and gas producers, and is being tackled as we speak. The other area is to actually put investments in electric and autonomous vehicles as well. And I would not want to cite examples, but you have specific investments in specific brands to tackle Tesla maybe, but to tackle other electric vehicle providers. I hope that will answer. It's a long answer to your long question. I think there are several questions that are coming in as well. Do you want maybe Ramy or Suhail to tackle the one on the key trends that we are anticipating in our outlook for incentives and policy support required to achieve the ambitious renewable targets in the region, the type of policy support and incentives that we are seeing existing today, of course, in the region, but also developing. Suhail, do you want to tackle that one?
Yes, of course. So in the MENA region, as we have seen in 2020, the share of renewables claimed a higher share on the expense of fossil fuels and coal. And that is driven basically by governmental policies with the national targets set on average between 13 and 52% of installed capacity by 2030. Now, the incentives basically, as driven by the governments, will be through subsidies, for example, or regulations that make it easier for penetration of the private sector, and tax exemptions, for example, from the governments, financing from the government, and providing long-term payment guarantees as being a major off-taker of the electricity produced from renewable-based generation. This is what we are seeing in Saudi Arabia with the major renewable projects, the REPTO, Category A, Category B. They are being, of course, financed by the PIF and the sovereign guarantees provided by the Saudi government and the investment fund. And I believe that this trend is seen across several countries in the MENA region to incentivize and accelerate the penetration of renewables in the power generation mix.
All right. There was a question about the ever decreasing sale price under PPAs in the GCC and the risk it may pose in the long run. I mean, first, we need to agree on what we mean by ever decreasing sales price under the PPAs, because in theory, I mean, if there's enough competition between the generators and you are able to, as a single buyer, as Suhail was mentioning early on, if you are able to guarantee to yourself an ever decreasing sales price, I think it's a major achievement from a policy perspective. And in the interest of the consumers. Now, there is a risk element that I think is related in that question that we should also talk about. And I would like to continue what Suhail has been saying when it comes to the way the feed-in tariffs in some countries have been set up, the way the lower than needed, the lower than market prices under the PPAs have been set up because of that fierce competition and because of some of the incentives that are being put in place by some governments. It's true that we are seeing elements of those risks in some countries in the region. Some of them being the fact that they end up finding themselves with huge bills that the national utility has to pay because we take the examples of some of the large CSP plants that were signed at the beginning of 2010, 2011, and where prices have decreased dramatically globally, but the national utilities or the single buyers found themselves stuck with higher than market generation costs from those projects. So somebody has to pay that bill, and that's basically the risk that it poses in the long run, is that when you have technology costs decreasing, and I think that's another area that Ramy touched on a bit earlier when it comes to storage. One of the major mistakes that anyone can do at this stage is to decide what storage technology it wants to put, especially when it's put in a tender with a storage solution. So we've seen a couple of years ago Jordan tendering a solar PV plus lithium-ion battery storage project, and that in itself, given the huge potential for those technologies to see their costs decline dramatically over the next few years, I think that's one risk that any government or any regulator or any single buyer is not able to tackle, because there is that, I think, asymmetry of information and asymmetry of technology between the players. So I think from that perspective, the ever decreasing sales price or the PPAs should be, in theory, great news for the consumers and great news for the utilities, and great news also for those who are advocating for specific technologies. But the risk is that when you start singling out one specific technology solution for generation or one specific technology solution for storage, you might end up indeed over a few years with a huge bill that somebody has to pay, and without transparency in the transfer prices between the different parts of the value chain, you will end up in a difficult situation. And we've seen some examples of that in the region indeed.
I will just add something, if you allow me, Dr. Leila. Linking this with the question on automotive and electrification of the automotive sector, because I've been studying, for example, the UK market, which is a very developed market in electrification of automotive and transportation. Until now, although they started back in 2010, 2011 with pilot charging stations, and you could see the small electric cars, the two-seater ones parked in the nice places in London. Until now, they are suffering with the lack of proper infrastructure outside the major civic centers. So the issue of infrastructure availability, and again, who is going to pay for this infrastructure to incentivize the adoption or the wider adoption of electric vehicles? This is one thing. The other thing is the standardization. So I'll draw a simple analogy from the mobile phone market. It took the industry several years until we could unify the chargers to USB and the Apple type of chargers. You used to have different chargers for the different makers of the phones. So the same thing applies for the electric vehicles. A Tesla charger is different than a VW, different than a Toyota that work on electricity. So in our countries, this will be a challenge. So that was just a point that I wanted to add. Thank you.
Thank you. I am told we have maybe less than 10 minutes before we run out of time, and we still have a few questions to answer. So I think the question about the views on the older PPAs, our views on the older PPAs and where the buyer is paying a very high price, I think I briefly tackled some of it. And without displaying any confidential information, I think it's definitely the time now, not for renegotiation of those PPAs, but we are seeing in a couple of countries in the region where that is happening, and where you will see financial engineering in place to make sure, as I mentioned, that somebody is paying that bill, and that the difference between the high price of the historic PPA and the current electricity prices. So I hope that answers that question. I would like to call on Suhail to help me answer the question on the tariff plans for the next few years to meet the power mix plan. I think Suhail has already started hinting at the fact that in the region we mainly have single buyer models with long-term PPAs, and the tariffs to the end user are definitely either regulated by the government or by the national utility, or where you have captive clients dependent on the relationship and the PPA that you have with your generator. So from that perspective, the model is relatively simple to devise what sort of tariff plans you will have. I think the remaining question is at what generation costs you will see in the future. And I think the LCOE graphic that Suhail has shared with you gives you an idea of the future of the generation costs that we will see in the region. They should be decreasing costs in the future. And now the difference between the residential and commercial tariffs and those generation costs at the utility level are up to the government to decide whether they want to subsidize that or not. And usually what is happening now in countries like Oman or Morocco, where you have deregulated, let's say, distribution, basically the government takes charge of that by subsidizing the distribution companies directly. So from that perspective, I don't think we will see major changes when it comes to our tariff plans in the next few years. I think what will be most important to meet the power plan mix is what sort of generation, what sort of technology and fuel mix you are introducing in your power mix plan. Because if you are able to unlock, as I mentioned, a lot of gas, a lot of low cost gas, a lot of low cost renewables, that will enable you definitely to decrease your generation costs. Suhail, did you have anything to add on that?
Yes, one thing I can think of regarding the tariff structure, for example, in Lebanon, there has been talks that in order to de-risk the tariff structure in Lebanon, the tariff has to be linked to the currency exchange market, for example, especially in markets where the currencies are pegged to the US dollars, for example. The tariff could be linked, for example, to inflation rates and the consumer pricing index to make sure that the private company who's generating electricity is breaking even as there is a fluctuation in the currency markets, or there is a high inflation, or for example, it can be oil and indexed to fuel prices, either oil or gas. So that was a thought in Lebanon for the tariff restructuring. Also, one thing in a bracket structure for the tariff, some systems, they subsidize all the brackets equally, even heavily subsidize the high consuming blocks in the tariff structure, what doesn't make sense, since the low brackets have to be more subsidized than the higher brackets. So I think that would be an idea for the tariff restructuring that policies might strive to achieve.
Thank you, Suhail. In the remaining 5 minutes that we have in this webinar before technology tells us to leave, I would like to tackle the last two questions, and Suhail, Ramy, feel free to jump in if you have anything to add. I think our dear friend Mustafa Uki asked an important question again about the impact of future international decarbonization measures on investments in traditional energy segments. And again, I mean, Mustafa, that's a large, broad question. But if by traditional you mean basically hydrocarbons, oil and gas, coal, and traditional technologies, I think from that perspective, our view at APICORP is that I think to tackle climate change, you will need engagement policies and strategies. Exclusion strategies will not work because you will need all types of technologies to be able to give access, still affordable energy to all, while at the same time trying to tackle climate change. That's why, for example, we insisted on the financeability and the bankability of CCUS projects that have their own risks, and we can have a separate discussion about CCUS later on. But I think from that perspective, in the foreseeable future, we still see the requirement to continue to invest in what you call the traditional energy segments because they're just needed, highly needed. And on the likelihood of policy changes in the region, net zero targets by 2030, I know my colleagues might have their own opinions. I think potentially yes, because for the exact reasons that I detailed in the slides on net zero or low carbon products, hydrogen and ammonia being examples, what I seriously believe that you would see a race for that because the region really has a potential for that. And from that perspective, for these countries that are well positioned to sell these net zero products, they will have to come up with certifications that their products are actually net zero or zero carbon products. So they will, at the end of the day, have to come up with net zero targets themselves to be able to be credible to the international community in that race. So I think for very specific countries in the region, you might see at least some talk about net zero targets by 2030. But maybe Suhail and Ramy have a totally different opinion on that.
Ramy, do you want to?
Well, I was going to say that before the net zero, you have the GHG emissions. It's a thorny issue that needed to be tackled long ago, and is now starting to gain the attention of the governments in the region, because it's no longer tolerable, while the world is speaking about net zero, that we have among the MENA countries some of the highest GHG emitters in the world. And this is why in some countries started to take drastic measures to reduce their greenhouse gas and carbon dioxide emissions radically. We're talking about Egypt, for example, Saudi Arabia, the UAE, Algeria is also joining. Iraq has always been very ambitious in this with the gas capture and gas to power projects, but unfortunately they are always faced with challenges on fiscal and economic and political aspects. But before the net zero, the region is trying to tackle the GHG emissions.
Suhail, I think we would agree with Ramy.
Actually, I wanted to tackle the subject from a different perspective, from the financing perspective, because whether we achieve net zero or not, we should follow the money basically and where the investment is going. So with the after 2020, we are seeing all the green bonds, the green stimuli packages being issued in the US, in the EU, and basically investments are moving. Even oil and gas companies and NOCs and IOCs are transitioning into the renewable space and into niche markets, which we never even thought they would be functioning in any time. So I think from now to 2030, in a 10-year time, it will be a transitional period. I think natural gas will play a transitional role until renewables become really cost competitive worldwide, and we can have the full transition. And hydrogen, of course, and ammonia will play a role. But I think from now in this decade, these 10 years, I think fossil fuels and natural gas specifically will be a transitional fuel that will be an essential part of the mix. But as we have seen this year and last year, the investments and the stimuli packages are moving away from oil and gas and fossil fuels and more towards renewables.
Thank you. I'll finish with answering just the last question. Somebody sneaked in one last question before we were supposed to close. Small scale green hydrogen, less than $100 million. We don't envision them in this outlook over the next 4 to 5 years. Not now. So you will have to read the next investment outlook that is supposed to be issued in March to have the answer. For now, we don't see, for the reasons that I mentioned, including costs. We don't see for now viable, especially small-scale green hydrogen in the region in the short term, at least. In the longer term, that's another question. With that, I would love to close this webinar. I would like to thank you for attending and wish you a safe, healthy, and sustainable 2021 and beyond. Thank you very much.
Thank you everyone for joining.